So passive investments achieve exponential growth in recent years due to the low cost and performance of these funds. But the term passive can be confused for doing nothing. However, it's an active decision to select the appropriate passive or index fund in this ever-growing universe of funds. So today in our panel, our first speaker is Gareth Stobie from CoreShares that will discuss multi-asset index funds. And he will be followed by Nico Katko from Satrix that will discuss the nuances of index investing. And lastly, we have David Swanwick from Dimensional that will discuss smart beta or factor investing. Just a reminder to please post questions in the Q&A box at the bottom. And if we don't get to those questions, we'll answer it in the breakaway room. So I would like to hand it over to Gareth.
Morning, thank you, Diane. Let me pull my slides up here. Super, well, nice to be here, even if it's virtually. And I'll kick off straight away so that I'll leave time for everyone else as well. I guess how I wanted to frame the benefits of passive or indexing is within the context of the financial planning world and trying to help clients meet their particular financial goal. Because at the end of the day, the process of financial advice from a needs-based analysis point of view is to help a client reach their particular goal, their particular savings outcome. And what I'm going to try and demonstrate here is how effectively indexing can be used in order to meet that goal, meet that outcome with the highest level of predictability. So if you're trying to build a solution, trying to meet this outcome or this goal, there are really kind of two bits of information that you're dealing with. There are a number of what we would call uncontrollable or speculative parts of the equation. And one need only look at the turmoil of the world over the last sort of 24 months, whether it's geopolitical turmoil with Trump's departure and his leadership over that time, or obviously COVID, the market correction, and then the market recovery, and some of the individual company events over the last while. Take Sasol's crash and then recovery as well, to demonstrate that to call markets, asset classes, companies, interest rates over the nearer term is incredibly difficult to do. Some people might get it right and you might get a call right, but to consistently do that is very, very difficult to do. So when looking at kind of the board of what you can work with, there are a number of uncontrollable or speculative aspects that we would want to, as a firm, sort of park to one side and say, well, there's only so much you can do with that. Then there are the controllable aspects of investing, aspects that are deeply supported by research, that have this body of evidence behind them, that are repeatable, and because they're repeatable and because there's so much structure around them, you can use these pieces of evidence in a sort of more controllable way. So what are the controllable parts of putting a client solution together? I'm going to hone in on 4 today. There are a number of others, but let me talk about some of the 4 key ones. And as I go through it, you'll soon start to see how indexing starts to play a very important role in it. Because once you accept that those uncontrollable speculative parts are very hard to get right on a repeated basis, one can move over to this controllable and evidence-based environment that has more consistency to it. So I'm going to look at the 4 key levers of this sort of controllable environment, and that's asset class returns, strategic asset allocation, diversification, and cost. 4 controllable levers. Lever number 1, asset class returns through time. I mean, we often talk about these different asset classes with a fair degree of confidence, because that confidence stems from decades of observation and decades of experience in appreciating how different asset classes behave through time, what your expected return should be from those asset classes, how they are correlated to one another, and so forth. And we often cite a database called the DMS database, which stands for Dimson, Staunton, and Marsh, who are a bunch of academics from London Business School. And they have mapped global markets, not over the last 20 years, but over the last 120 years. And from that long body of history, you can pull out returns and return profiles and correlations from the different asset classes. And you can then start to put those asset classes together in a multi-asset framework, in a strategic framework that makes sense for trying to achieve a particular outcome. And let's benchmark our outcome relative to CPI, for instance. We know that over the longer term, you should expect a significant return premium to inflation through time by having your money in the equity markets relative to cash and bonds, for instance, what these gentlemen called the triumph of the optimists. So whilst it feels uncomfortable for clients at times to have a high equity allocation, we know that, for instance, equity drives longer term returns above inflation, whilst other asset classes are more defensive and have other correlation benefits. So one can take these asset classes and put a portfolio together that structurally or systematically helps build a client outcome relative to, say, a CPI benchmark that has got backed up by decades of data. So that's how one builds this sort of this framework of strategic asset allocation. But hang on, I mean, managers are often saying yes, but we can trade depending on how we see the market, and we can take bets on certain currencies or certain asset classes and tactically provide returns that are better off than just simply having a strategic framework. Well, research that we have done actually suggests that most managers, in terms of their tactical asset allocations around their strategic benchmark, don't add enormous value through time. Yes, you might get points in time where they add enormous value, and you might have an outlier event where the manager got it particularly right. But if you look at rolling returns, and we looked at it over a 15-year period, more often than not, managers have actually detracted from their long-term strategic asset allocation by making tactical asset allocation calls. From a client standpoint, looking at rolling periods of returns, the manager would have been better off being in a strategic asset allocation framework. 48.18% consistency relative to the benchmark versus only 32%. And that's because these tactical asset allocations are often made around some of those speculative, difficult to control inputs. The third lever that one can pull, particularly in today's modern age of indices, is that of diversification. The South African benchmark, kind of the most spoken about one, the top 40, for instance, is often criticized, for example, because of concentration issues that it has within its index. And that's fair criticism, because probably 8 to 9 stocks of the 40 stocks statistically drive the return of the top 40. You might as well not be invested in the other 30 odd. However, in today's world of indices, you are able to build new indexes that take into account more prudent diversification, better portfolio construction from a risk-based point of view, and give you exposure to well-rewarded, well-researched area of actually active management, and that's the world of factor investing. So quality shares, value shares, momentum shares, and so forth. And here we see the difference between a top 40 index, which has been a very good investment and been difficult to beat for a large part of the active market, but also the merits of smart beta or some of the other indices that are available that help to diversify the portfolio, add additional stocks to the portfolio, and add additional return drivers to the portfolio. And this type of smart beta approach or factor approach is available in index design. And then lastly, cost. Again, some research that we did over the same period in the low equity category or CISA category showed that actually funds that had low total expense ratios had far higher consistency in terms of outperforming their CPI benchmark than funds that had expensive total expense ratio. And Morningstar, for instance, is cited as saying that both globally and in South Africa, if you sort of closed your eyes and picked funds based on just one criteria, cost is probably the most important criteria to hone in on. So having a lower cost within a fund provides this sort of structural head start to a fund's return. And this consistency of outperformance of the benchmark is in part caused by lower costs versus higher costs. I'm now going to reverse a bit and just flick through the 4 points and show how indices play a role. So strategically, we can allocate to the different asset classes through a low-cost index format, strategically, mechanically, do that in a sort of systematic way to achieve the client outcome. There isn't a lot of benefits of tactical asset allocation around that outcome. You may or may not get it right. You may or may not call COVID or Trump's success at the elections and so forth. Today's indices provide not just concentrated market cap indices, but also highly diversified indices that give you exposure to well-rewarded factors through time. And lastly, you are able to keep costs very low within the solution. Over the last 12 months, CoreShares has been working with the Efficient Group and BCI and their multi-manager team in their select range. And they have launched 2 new multi-asset funds, a high equity fund and a low equity fund. The high equity fund has got 78% allocation to risk assets, so property, global equity, local equity, for instance, whilst the low equity fund has got a 43% allocation to risk assets. Because they are implemented primarily passively, one can keep the cost low with a total expense ratio of only 47 basis points. And these funds have been designed in a systematic way in order to achieve the highest level of predictability relative to the benchmark and to achieve the best possible outcome for clients using the strategic asset allocation, using the best-in-class indices, both market cap weighted type indices, but also allocation to mid-cap stocks and multi-factor type shares. And we would say that this is the new generation of multi-asset funds and how it can be approached through absolutely through a passive framework with very little active management or tactical asset allocation overlay. Thank you.